Good morning, ladies and gentlemen. Welcome to Business Law. Today we want to look at capital of a company. Now, capital refers to the amount invested in the company so that it can carry on its business activities. In a company capital, this refers to share capital. The capital clause memorandum of association must state the amount of capital with which company is registered, giving details of number of shares and the type of shares of the company. A company cannot issue share capital in excess of the limit specified in the capital clause without altering the capital clause of the Memorandum of Association. Capital is a term for financial assets such as funds held in deposit accounts. While money is used to purchase goods and services for consumption, capital is more durable and is used to generate wealth through investment. The four major types of capital include debt, equity, trading, and working capital. Now, to be considered capital, the goods must provide an ongoing service to the business to create wealth. Capital must be combined with labor, the work of individuals who exchange their time and skills for money to create value. By investing in capital and current consumption, a business or individual can direct those efforts into future prosperity. Tangible assets that function as capital within a business are subject to depreciation, which occurs as normal wear and tear on an item, diminishing its overall value. Depreciation is often noted on a business's financial statements and may be eligible for the use as a tax deduction. Now, the accession of property rights designates the value of the associated capital. Individuals or companies can claim ownership to their capital and direct its function to suit their needs. Ownership of capital can also be transferred to another individual or corporation, with any resulting proceeds from the sale being directed to the previous owner. For example, a business can sell a piece of production equipment to another facility in exchange for cash. The purchasing facility becomes the new owner of the equipment, and the selling business can include the funds as revenue. Now, let's look at types of capital. Now, we are going to look at these four types of capital: debt capital, equity capital, working capital, and trading capital. Now, let's talk about debt capital. Now, a business can acquire capital through the assumption of debt. Debt capital can be obtained through private sources such as friends and family, financial institutions and insurance companies, or through public sources such as federal loan programs. Now, if we're looking at equity capital, this is based on investments that, unlike debt capital, do not need to be repaid. This type of capital can include private investment by business owners as well as contributions derived from the sale of stock. Now, working capital. This is defined as the difference between a company's current assets and current liabilities. Working capital measures a company's short-term liquidity, more specifically, its ability to cover its debts, accounts payable, and other obligations that are due within a year. In a sense, working capital is a snapshot of a firm's financial health. And then lastly, trading capital. Now, trading capital refers to the amount of money allotted to buying and selling various securities. Generally, trading capital is distinct from investment capital because it is reserved for more speculative ventures. Trading capital is sometimes referred to as bankroll. Investors may attempt to add to their trading capital by employing a variety of trade optimization methods. These methods attempt to make the best use of capital by determining the ideal percentage of funds to invest each time. In particular, to be successful, it is important for traders to determine the optimum cash reserves required for their investing strategies. Now, let's look at examples of capital. Now, while money is used to purchase goods and services for consumption, capital is more durable and is used to generate wealth through investment. So examples of capital include automobiles, patents, software, and brand names. All of these items are inputs that can be used to create wealth. Besides being used in production, capital can be rented out for a monthly or annual fee to generate income, and it can be sold when it is no longer needed. Now, we want to define a share capital. Now, a company's share capital or capital stock is the portion of a corporation's equity that has been obtained by the issue of shares in the corporation to a shareholder, usually for cash. Capital and share capital are synonymous. Share capital means the capital raised by the company by the issue of shares. Share capital is not a necessary condition of incorporation of a company, but the memorandum states that the amount of capital with which the company desired to be registered and the number of shares into which it is to be divided. The share capital is different from membership fee, even if the payment is symbolized by the issue of a share. So companies limited by guarantee and unlimited companies may or may not have share capital, but companies limited by shares must necessarily have share capital. In a strict accounting sense, share capital is the nominal value of issued shares, that is the sum of their par values as indicated on the share certificates. Now, let's look at the offer of shares. Now, the following different terms are used to denote different aspects of share capital. We have nominal capital, issued capital, subscribed capital, called up capital, and paid up capital. Now, nominal capital, this means the sum mentioned in the capital clause of Memorandum of Association. It is the maximum amount which the company raises by issuing the shares and on which the registration fee is paid. This limit cannot be exceeded unless the Memorandum of Association is altered. And then issued capital. This means that the part of the authorized capital which has been offered for subscription to members and includes shares allotted to members for consideration in kind. And then subscribed capital. It means that part of the issued capital at nominal or face value which has been subscribed or taken up by purchaser of shares in the company and which has been allotted. Called up capital means the total amount of called up capital on the shares issued and subscribed by the shareholders on capital account. And then finally, paid up capital. This means that the total amount of called up share capital which is actually paid to the company by the members. Now, let's look at loan capital. Now, loan capital is funding that must be repaid. This form of funding is comprised of loans, bonds, and preferred stock that must be paid back to investors. Unlike common stock, loan capital requires some type of periodic interest payment back to investors for use of the funds. However, these investors do not share in the profits earned by the organization, though they have payment preference over the shareholders in the event of a business default. Now, an excessive amount of loan capital can present an increased risk of default for a business, since the interest liability associated with the loan capital may exceed the ability of the entity to make these payments on a timely basis. Loan capital is money or capital needed to run a business which is raised from borrowing rather than shares. Businesses raise loan capital in three main ways. That is bank overdrafts, bank loans, and debentures. Just to briefly explain before we get into maintenance of capital. Now, debentures are medium to long-term debt instruments used by large corporations to borrow money at a fixed interest rate. And then a bank overdraft, it occurs when you withdraw money from your bank account and the available balance goes into negative numbers. The account is overdrawn. So if you already have an agreement with your bank for an overdraft and your balance is within the authorized limit, you will normally be charged interest at the agreed rate. And then a bank loan, businesses most commonly borrow capital through bank loans. They provide medium or long-term finance. Now, maintenance of capital. So, capital maintenance is a concept used in accounting to refer to the principle that the income of a company is only fully recognized after being sure that capital has been maintained and all costs have been recovered. Your company will achieve capital maintenance if at the end of a period the capital that a company has is unchanged. At this point, any excess will be considered company profit. Capital maintenance can also be referred to as capital recovery, and basically means that the company only generates a profit once all of the costs associated with the operations during the accounting period selected have been fully recuperated. Now, let's look at calculating profit. Now, to effectively calculate profit, you must know all of the business's financial and capital assets it possesses at the beginning of the defined period. There are two primary subsections of capital maintenance: financial capital maintenance, physical capital maintenance. Financial capital maintenance. So according to IFRS, or International Financial Reporting Standards, financial capital maintenance is defined as the profit that is earned once the amount exceeds the net assets by the end of the period of time selected. This calculation will exclude any of the amounts that have been flowed in or out of the owners, such as distributions and contributions. When determining these amounts, you can measure them by either monetary measures or constant purchasing power units. In regards to financial capital, you only need to be concerned with actual funds that the company has at the start of the determined accounting period. It does not include the value of other capital assets the company may have. Okay. So this means that certain items will be excluded from physical capital maintenance, such as the costs that are associated with maintenance of tangible items such as equipment. Physical capital maintenance will instead focus on the company's ability to sustain its financial capital, such as cash flow. This is done by maintaining the income-generating assets in the business to maintain the company's cash flow. And then let's look at physical capital maintenance. Now, while physical capital maintenance does not always have a specific definition, one of the components that make up physical capital maintenance involves replacement costs, which means that income can only occur after all the costs of replacing the capital of a company has been replaced. By the definition set forth by the IFRS, profit is earned by the company only in the event that the productive and operating capacity of the business meets or exceeds its capacity that it started with at the beginning of the period chosen.